Hey, good morning, everybody. It's Monday, March 2nd, 2026. I, of course, am Hammer, founder of Originator Success, Grab and Go Social, and Rate Sensei, three great products from Hammer Solutions that help my originator friends get more business from Google and social media in 2026. Be sure to check those out. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern Time on Facebook and YouTube. A lot to cover this morning. Today, we're going to be, of course, talking about what's going on with the Iran situation. Quick note on that. You're welcome to share how you feel about the attacks, but this isn't political commentary, and I'm not a political commentator, so we're not really going to go deeper on that. I'm certainly not going to defend or attack the attacks. What we are going to do is go deep into what effect they have on mortgage rates and where things go from here. So that's what we're going to spend our time on today. Again, if you guys want to share your feelings, I wouldn't stop you. I'm not really going to go all that deep. It's a complex topic, and I don't really have singular feelings on it, believe it or not, one way or the other. I just kind of, that's how I roll. So anyway, want to make sure we get that out of the way as we talk about it. So of course, we're going to be talking about what's going on in Iran. Let's see, is Siegel on yet this morning? Here he is, Ron Siegel. Yeah, I just a little bit of a late start, but anyway, give Siegel kudos. He was the one that was talking about Iran. I did not think anything was going to happen, but I should know better. Trump definitely does like to take action over the weekends. But Ron, you called it. You said pay attention to the. We've had situations with other countries for a long time, and don't generally see a thing like this. So I did not really go into detail on it ahead of time. So we'll talk a little bit more about it now. Of course, other stuff we'll be talking about. It is still a big week for labor market. We'll look back on where mortgage-backed securities and the 10-year Treasury were on Friday before this whole thing started in Iran, and what the groundwork was laid for and what kind of direction we're going today. So anyway, if you're here this morning, say good morning. Hi to all the live folks. Good morning, Greg Favola and Rob Wilson. Siegel said I was a couple minutes late this morning. Sorry, couldn't set your watch on me today, my friend. So everyone else here this morning, Randy Teakle, giddy up, sir. I'm still fighting the head cold, so my head's really all over this morning. Well, that I absolutely agree with Ron. Ron said, America's at war. Regardless of one's opinion, we should be supporting and encouraging our men and women in harm's way. I think that everybody could pretty much agree on that one. But that might be all that they agree with. Why they're in harm's way or how much harm's way they're in, or all kinds of things. Certainly going to be up for debate. So good morning, Einkorn, Jerry Avila. Great to have all of you here. All right. So let's jump in and get into it. Quick recap on what happened on Friday. Really kind of need to go over that first to take and figure out kind of where things are and where they're going from here. So taking a look here on Friday, let me put this on the 5-day and let's kind of zoom in a little bit here on a few different things. So taking a look, we can see that we had mortgage bonds moving up again. And when mortgage bonds move up, that puts a smile on our face. That's a good thing, right? So on Thursday, on Friday, we were seeing a very steady increase in mortgage-backed securities, and very significantly, they had broken above the 100.38 level right here. And that was key. Friday was shaping up to be a day where we were expecting, as we rolled into this week, that we might see some pretty good improvements, right? So taking a look here, you can see that mortgage-backed securities end of the day on Friday, 100.50, well above the 100.38 that runs right about here. And we wanted to see if we had confirmation this morning. Now, this morning, of course, we are down here, well back below 100.38, currently at 100.18, down about 31 basis points on the day. What does that mean? That means rate sheets are going to be worse, of course. So we'll figure that out. But before I get too far, also wanted to point out, look at that 10-year Treasury yield, currently at 4.02. It had fallen well below 4 at 3.94 on Friday. 3.94. This was a big green flag. Not just a green candlestick, but a green flag. The opposite of a red flag, if you will. A red flag, signaling problems. A green flag signaling we were in a position heading into this week where we might have seen some of the best rates we've seen for the year. That was at the end of the day on Friday, right? So we were in a really good spot on Friday to see rates improve a little bit this week. Not that they would have moved tremendously lower, but maybe even enough to see an eighth of a point lower if mortgage bonds had continued to build on Friday's good fortune. Again, unfortunately, though, that is not the case this morning. Mortgage-backed securities currently are down about 31 basis points on the day. Let me just go ahead and adjust this, and we'll look at all that together here. I'll put this right about here for now, and let me bring this up a little bit. There you go. Okay. So taking a look, you can see if we take a look on the 2-day chart, you can see it very clearly right here. We lost a tremendous amount of ground in overnight trading. That, of course, was due to everything that's going on over in Iran. I'm sure I don't have to tell anybody that the U.S. did attack Iran. Iran retaliated back. Again, not really going to go into the whole details of what effect it has, but here's the key. All right. One of the big things that is affecting mortgage rates this morning is the effect it's going to have on oil, and that the attack will have with oil prices globally. Because remember, we may not get a ton of oil from Iran, but Iran does provide a lot of oil for China and Russia. So again, I don't want to get into too deep about kind of which direction. There's really, when it comes to Trump is very erratic. He will say that this is going to be over in just a couple of days, and then he says it may last weeks. So you can't really read into anything that Trump says, because it'll change on the fly. And again, this is not a Trump bash or a Trump support situation. It's just trying to look at what kind of how this is all going to play out, how this is going to continue to go. Now, the main thing, it's the question is, how much worse will mortgage-backed securities get from here? How much worse will the 10-year Treasury yield get from here? Will we see the yield go up to 4.25? Like, that would be huge. That would be a terrible scenario. Will it kind of improve again? Not likely to see it improve anytime soon. So anyway, over the weekend, the Iran attacks caused concerns about jumping oil prices and inflation. Normally, when you see that there's a conflict, there'd be a kind of an argument that we should see a flight to safety for bonds right now, and that money would be moving from stocks into bonds. Bonds would be improving. We expect to see safe havens do well. However, the idea of money going into bonds has taken a back seat to the fact that there's concern that oil prices are going to continue to move up. So oil jumps 10% on the Iran conflict, could spike to $100 a barrel, analysts say. That's a big deal. Let me squeeze this in a little bit so you guys could see the full headline. There you go. Oil jumps 10% on Iran conflict, could spike to $100 a barrel. That's a big deal. So that's why you're seeing that wash out about safe haven. So rate sheets today are going to jump. On Friday, we were still flirting with that sub 6% level, 5.99. How much will they jump today is the question, right? If we take a look at mortgage bonds and you look at where we're at, so right now we're at 100.21. We were at 100.27 on last Wednesday, on the 25th, right? We started the day at 100.21. We improved to 100.27. Rate sheets on the 25th, not really all that bad. 6% compared to 5.99. Realistically, we'll see rates jump probably an eighth today. You're going to see lenders that are going to be a little bit more conservative in their pricing because they don't know necessarily which way things will go. And they don't want to get caught out on loans. More aggressive lenders will price a little bit more aggressively. But generally, at worst, we'll see 6 point, probably back up to where we were here, like 6.05 or 6.08, 6.10. Now, if you look at the 12th, when we were at 6.10 and you look at what collaborated, we were at 100.25 to get to that level there. And again, we're at 100.21. So you do see some variation to that. That was on the 12th, right? When we were at 6.10. and you look at kind of where rate sheets were, lenders have been pricing more aggressively because rates were creeping in that direction. Bonds were holding steady. I think this will spook rate sheets. I think your rate sheets will jump. You'll see about 6 1/8 compared to the sub 6. Ron says oil will continue to jump from here. Let's see what you guys have to say on this. So, and yeah, a lot of the future of where rates and pricing are going to go from here. I'm going to talk about the things here, right? A lot of that has to do with where things go. Oil will continue to jump. We don't get oil from Iran, but Saudi Arabia shut down due to the Strait of Hormuz being closed right now. Yes, and I have that up here on Google Maps so that people can see that. And that's one of the kind of what I was going to say is that this is the Strait of Hormuz right here. This little blurb right here. And so yes, the oil that we do get now, I think that if prices do go up, I think that we'll see a little bit more output from domestic sources, or we'll dip into our stockpiles to keep prices down. We've also seen OPEC Plus say that they were going to and by the way, I know that Russia produces a tremendous amount of oil. I still think they do get some oil from Iran though. They might resell it. I don't know, but anyway, I think we'll see our stockpile stuff. OPEC Plus said that they would increase their production to offset it, but like Ron is pointing out, it's currently there. Ron said, interesting to watch a flight to safety going into gold and not crypto. I'd be surprised to see a flight to safety into bonds, which would be good for us. So yes, we could, and that's why right now, I'll throw this on the bottom and get rid of that other caption. Right now, I would be cautiously floating everything. I wouldn't lock anything. You don't want to panic lock anything right now. We need to give time for this to settle in a little bit. Like what Ron is saying, that it's not necessarily a surprise to see that here. So Carmen said, respectfully, this makes no sense to me. Stocks are down, which retreated into bonds, hence push down rates. Am I wrong on that? Usually bad global news and traditionally good for interest rates. Carmen, you're not wrong, but you're also not right enough. So the flight to safety has been more in gold than in bonds. And even though we will see some move over to bonds, bonds are taking more of a bath because of the idea that when you see oil prices jump 10% and threats for oil prices to go up to $100 a barrel, this is hugely inflationary. This is a big, big problem with inflation. And inflation is, of course, the detriment of bond prices. So that's why you're not seeing, and also there is some pushback on how safe U.S. bonds are right now. There is pushback on America right now. And, at the end of the day, traders and different countries are going to be self-serving. And if it makes sense to invest in U.S. bonds because that's the best place to put their money, they will. But that's not necessarily what it is. When you look at the safe havens, I had one of these as let's see if I can look at the bookmarks here. Saved. Sometimes they don't save from the app to the main one here, but yesterday they had one of the articles. Here you go. So Wall Street turns to safe haven, and this was an article that was from yesterday. If you take a look here, that was from yesterday. So this kind of goes into what Carmen was saying. So Wall Street turns to haven first strategy, the conflict across the Middle East, heightening investor anxiety, strengthening the case for safe haven trades such as treasuries, gold, and Swiss francs. Traders are adopting a strategy of haven first, ask questions later, with the possibility of prolonged turmoil in the Middle East and the ripple effects of higher oil prices, giving money managers fresh reasons to sell equities and shift into safety. Investors are watching energy markets and the Strait of Hormuz with some warnings against quickly buying any dip, and others expecting a spike in oil price and lower U.S. rates and gold up and equities down in the short term. So, you see, this is how you would expect to see it, where there would be more money going into safe havens. The problem is that with everything's happening, look at, this is gold. You can see gold is what has gotten like the most bit of a jump here, over the last, this is again, all of February, basically. And then you can see where everything else has been a lot more flat, including long-term treasuries, which is this gray line right here. So short-term treasuries get a bump, but long-term not getting anywhere near that same bump. And this is, like it says here, this is about Hormuz risk, not retaliation. If shipping stays open, stocks can work through it. If it doesn't, all bets are off. And that has to do with, again, getting oil through this Strait of Hormuz right here, and Iran trying to shut this down and block this off. Again, they also attacked Dubai's airport, which I think it said was the busiest airport in the world, was one of the headlines that or not headlines, but something I read in one of the different pieces there. So that's kind of all of that a concern with how this plays out. But overall, right now you want to cautiously float, right? We want to definitely be watching and seeing how this is playing out. As some of you have said, the oil prices today for sale 90 aren't oil prices today for sale 90 days out. I don't know too much about that. I just know what it's trading at, and that's what everything's going to react to that. Look at oil stockpile increased on MBS Live last week. We're getting a lot of oil from Venezuela. Remember, the markets always overreact. Be patient. Yeah, I can't disagree with Ron in the least on that. And that's kind of why I'm in a cautiously floating stance and not locking. We've seen a very strong reaction. We just need a couple of days to let that settle in. And then on top of that, remember that this is still jobs week. We still have jobs data this week. So looking at where things are at and pulling up the economic calendar, keeping an eye on, let's make this a little bit bigger so you guys can see it, right? So looking at this week and where we're at today, we've got, PMI numbers at 10 a.m. Not likely to have much of an effect because of everything going on today. Tomorrow is a bit of a calm day. Wednesday, we get the other non-manufacturing PMI data. We get the jobs, ADP jobs data. Notice we don't have the where's job opening. So no JOLTS data this week. That's kind of unique. Usually JOLTS data is at the same time, but the Bureau of Economic Analysis JOLTS data release dates. Let's see. So JOLTS data, Bureau of Economic Analysis has been behind, but the Bureau of Labor Statistics, BLS, they had kind of come in on track here. So, but that is, March 13th. So that's going to be next week. So it's funny how that has now pushed off to a totally kind of different week than the rest of the labor market data. So no JOLTS data this week. That will come next week along with CPI inflation data. But this week you've got retail sales on Friday morning, and then of course all the BLS jobs reports, non-farm payroll, wages, and everything. So there's a lot of activity this week, and of course the leader of this activity right now is what is going on with the Iran scenario situation. But it's still too early to get freaked out and lock everything up. Let's wait and let this pan out. We could see bonds get a little bit more of a recovery here, and new month bond selling also a factor. Arguably, yes, to some extent, Randy, but a lot less than everything else right now. Why would they attack Dubai? Because they were throwing missiles at everybody, man. They were like, again, I don't want to get too deep into the Iran scenario because you can read that Bloomberg, Wall Street Journal, Reuters, but they were attacking all over the place because their other Middle East countries are not defending them, and they're not, they're tied in with the United States. So that's in a nutshell why we're throwing throwing bombs all over the place. Arguably, as part of a bigger strategic, if they're attacking U.S. bases and, they don't want the U.S. planes to be able to come in all over the place, you could argue that was the reason why they were doing it as well. But bottom line is also with missiles flying all over the place there, the airports I would believe would be closing anyway. All the flights were turning around. Nobody's going to fly into a war zone to get on vacation, so that was kind of what was going on there as well. So, but as far as how bad will rate sheets get today, I'd like to see when they come out this morning. They should start coming out now. And how much of a reaction will we see? Because arguably, if you look in the past, you can see as much of a reaction as bonds were in a similar pricing area to be at, around 6 1/8. Or they could only go up a little bit here. I think they'll go up I think you'll see a jump in rates, and they'll go up to about 6 1/8. Generally, you're going to price more conservative in this. But looking at mortgage-backed securities in the past, again, right now we're at 100.17, so losing a little bit of ground. Last time that we were down this way, below that was the 11th and the 10th, right? We were, down below that level here. And you look at where that was when you look at rate sheet pricing, the 11th and the 10th, you're right here at that 6 1/8 ish area. And then when you go above that, even when you get down, these are all 20s. So yeah, that's where you kind of have to go to get an idea of where that is. Now, could we continue to see bond sell off? It's possible, but we should see some support with moves into safe havens while things are still unsure. So the initial reaction is the jump in oil prices, inflation. It's the initial reaction to all of this. Same thing with 10-year treasury yields. But I mean, look at 10-year treasury yields, 4.03, man, 4.02, 4.03 right now. Look at that, right in that 4 point, so call 4.02, 4.03. And it's certainly not below 4 like it was on Friday, but that is not high. Look at how much higher we were just a little while ago. We were in the 4.20s just at the beginning of February, so a month ago. And you look at what kind of a drop we've seen here. So this is very telltale that we don't have to panic yet. You don't want to make any hasty decisions. We just need to kind of sit back, let markets adjust a little bit today, see where this stuff plays out. So hope that helps, my friends. I'm going to wrap it up. Again, thank you for joining me. Appreciate y'all being here. I will see you tomorrow. We'll watch this situation continue to unfold and how things go, and we'll go from there. So hope you guys have a fantastic. And again, Ron Siegel, kudos to you. You were the only one that mentioned the Iran scenario. I didn't think it was going to be a thing. I did not think that we would see military action, especially over a weekend. Haven't really talked much about it, even though I've been following it somewhat behind the scenes, not as closely as you. I figured there'd be more pressure put on for a while before we saw anything. I thought it would be more broadcast, but you made a note that, hey, we could see this thing happen. So good for you, my man. Good for you. So again, I'm not really talking about the Iran scenario and what effect that has or how that should be viewed or the politics of it or anything else. That's not what I'm here for. It's not that I'm avoiding it because I don't want to. It's just, it doesn't benefit us to have that conversation. What you come here for is to talk about how's all this affecting mortgage rates. And that's our focus. How is it affecting mortgage rates? Anybody that wants to talk about it otherwise, well, you got Instagram, Facebook, and TikTok for that. So, all right, my friends, enjoy it. I'll see you tomorrow. Have a fantastic day. Bye-bye.